Whenever you're ready.
Cool. Just give me a minute. Cool. All right. Starting my speech in 3, 2, 1. If big investment banks are okay with like knowing what they're doing and necessarily making their consumers opt into bad trades, and we don't do anything about it, I don't think we should like make these banks who are acting in good faith. I'm going to do 3 things in the speech. First, I'm going to tell you why these banks are not liable for the harms they caused. 2, I'm going to tell you why, if they do end up paying back, this is going to be a significant amount of damage on like both these banks and Poland's economy. And thirdly, I'll tell you why this is going to strain like relationship of Poland with the like European Union. I'm going to start with why these banks are not liable. I have 4 major reasons for why this is true. The first thing I wanted to note here is that they encourage people to take these loans. They were not forcing people to opt into these loans. And what do there are like a couple of structural reasons for why exactly these people would have had options to take the loans out in zloty. Bank reserves like of these particular banks were in zloty, because like you don't really have like say like bank reserves in like francs for these particular banks, which means you probably had options to take it in zloty. But secondly, I want to note that if you have like Polish banking regulations and stuff, you possibly had to have amount of money in zloty in your banks, which means you had options to take it in zloty, which means you're not actually pushing people to go out and take loans in like say francs, but you're just giving them the option. But if you don't buy that, I want you to note this is nothing new, right? Before 2015, the practice of offering loans in Swiss francs was common in Poland, and many borrowers like willingly chose to take these loans because there's historically low interest and like there was stability of like Swiss franc. Who would have thought like Swiss franc would go south, right? But then I want you to note that this is something that is historically the case, and they were operating within the norms of what the market situations were right now at that point in time. I will go into what is the regret like before I take the clarification. Don't worry about it. Cool. Then the third thing I wanted to note here is that they didn't act in bad faith, right? What do I mean by this? Which means they could not have anticipated that suddenly the policy will change, like by Swiss central banks, and things will go down south. Which means that they didn't think that, oh, this is going to happen, and we'll like be negligent and not give it to, not tell our consumers. But rather they were just operating in good faith, but they didn't actually know what was happening. Which means they're not liable for like the third reason. But fourthly, they also followed all like regulatory compliance, where they actually like whatever they had to do to give the loans out in francs, they ended up doing all these regulatory compliance. Which means for all these reasons, they're not liable to like say like criminal action from consumer courts. Clarification, go.
If your teacher encourages you to answer C to a question where the correct answer is A, are they liable because they encourage you to do that and they were wrong and you trusted them?
So here's the deal, right? If they acted in good faith, if they acted in like say if that was the norm, and if everybody thought A was going to be right, I don't think they're liable. Cool. The second thing I'm going to do here, and this is the most important part, what exactly is the financial system collapse going to look like, and why is this going to be like incredibly bad if they had to pay back the loans? And there are like there are like many reasons for this. The first thing I wanted to note, right, is if you have to pay 25 billion euros in order to pay such a huge sum, you need to deplete the capital reserves of these banks, right? These capital reserves are essential for these banks to maintain liquidity and like say like meet the requirements that the Polish like government has. I think at the point in time when you can't go give out that much amount of money to like consumers, you probably have to like strain your reserves, and you have to end up taking more loans to go out and pay back to the consumers. What is the problem of this? And there are like 3 major problems with this. The first thing I wanted to note here is the characterization of Poland, right? They're basically an agro-based economy to a good degree. They don't have like say money like they have their own currency, which means they don't have integration with euros as much. Which means for people to take up loans in itself is very very hard in like Poland. The first impact of this is if these banks have to end up giving to consumers, which means for agro-based economy like this where they need a lot of loans, now like these loans become much more expensive, right? Why is this true? Because the banks have to necessarily like get more loans from other people, and now that they have like say more loans and they're not able to pay back because they had to pay all of this from their profit, right? The repayment of $25 billion will like likely result in like significant depletion of the profit, which means insofar as that is the case, they probably have like like bad credit ratings, which means they have to like whatever loans they're getting from external actors are going to be at a much higher rate. The trickle down of this is people are going to get like loans at a much higher rate. I'll take it later. Much higher rate, right? I think at that point in time, more people are going to like not get loans, and they're not able to like get capital to start their businesses and whatnot, which is like very important in Poland. But secondly, I wanted to note, right, insofar as this is not an interchangeable currency for these people, and most of this is most of these things are in euro, you need like you don't really have the access to the euro market as such, right? You're not easily able to get the loans in other banks as well, which means you're largely like reliant on these banks. But lastly, I want to note that the problem with this is also like multifold, right? At a point in time when most of like say Polish banks or like major Polish banks go south, or like they have bad credit rating and they're like struggling to like make ends meet, which is what like a $25 billion euro 25 billion euro fine will will essentially lead them to. I think the problem is there's also like market confidence issues, right? Poland is not like a very strong like market where it gets in in a lot of investors, because it's not in the eurozone. It's hard to do business there. Like the policies don't like go align with people for business, and but more importantly, you can't make payments in euros, which means it's very hard for people to go and do these things. Which means when the market confidence is already very low, if I make the banks there unstable, that means most investors are like, I am out of this, because there's a very good chance of like them like leaving, which means there's capital flight, the borrowing cost is going to increase, and the loss of market share is generally going to be like a problem for Poland. Before I go on, CEO, go.
Yeah, so the cost of 25 billion isn't a fine that you pay to the EU. It's just the cost that they have to lose in order to give people the homes without actually making them pay the reimbursement. It's just a one-off cost that they lose.
No, I get the point. The problem is if it's like just listen to what I was saying, right? If you have to pay 25 billion out of your pocket, you necessarily have to give it out of your reserves, which means you have to take more loans out. I don't care if you're giving it to people will go and drink it off or whatever. But then the next time they have to take an education loan or they're going to take an agriculture loan, it's going to be fucking expensive. Cool. The problem with this in euro relationships, right? I want you to note that there's already like Poland is primarily right wing. There are a couple of reasons for why this is true. One, they elected Tusk, he's a far right person, which means like we already can see that they're going in that regard. But secondly, I want to note, right, they disagree on major things major things in which the European Union has collectively agreed to. For example, sanctioning Russia is something that they don't agree on. Poland is not like agreeing to take more refugees and whatnot. I think at that point in time, it's very easy for you to like convince people that this is something that this ruling is very bad, and there are going to be like altercations from this ruling, and it's going to lead to bad euro relationships. More on this in deputy, but for all these reasons, propose.
Great. I thank the speaker very much for that fine speech. I'd like to give the floor to a leader of opposition to open their side in today's debate. Here.
Thank you. Just to check, am I clearly audible? Very good. In which case, I'll start in 3, 2, 1. We're going to show you that the banks actively knew the risk and pressured customers into going and buying these products. This will show you A, that the banks are legally liable, B, that if we don't punish them, there is a risk of them pushing other risky products on consumers, and C, that we have a problem with the rule of law. Then we are going to show you that we prefer that the banks bear the burdens rather than the customers, because they're better able to bear these burdens. But before we do that, some direct rebuttal. A, about the idea of higher interest rates to consumers. Note that not all Polish banks were involved in this issue. Therefore, the other Polish banks will still offer the same interest rate as before. If these banks demand higher interest rates, they are going to lose market shares to other banks. We are okay with this because that means the consumer is still getting the same interest rates he used to get simply from other banks. In Poland, there are other major Polish banks, as per the info slide as well, so the average intelligent auditor should know. Second, note that the Polish banks have access to the reserve bank, right? The Polish central bank offers very advantageous loans to Polish banks that are under economic stress, because Poland does not want the banks going out of business and losing access to consumer funds. That means that even if there is some amount of stress, the Polish central bank will just give the Polish banks money to continue operating. And they have a currency swap with the EU, which means they have access to euros. And finally, and third, we think is important, mortgages, and especially Swiss-backed mortgages, are a very small part of Polish bank businesses. That means that most of their business is still ongoing. 25 billion euros is a lot of money for the average citizen. For several major Polish banks, it's not that much money. So we think the impact we have here is very small. Finally, just about the politics point, Tusk is a centrist pro-EU politician. We don't see why they're going to spin giving money back to citizens from banks as anti-Polish people. It's a very odd case. Let's get to our main case about why they knew the risk. Look, mortgages are things you take for 25 to 30 years. Banks know that foreign exchange is unreliable. They know that something is going to happen within the next 25 to 30 years that is going to change the exchange rate between the zloty and the franc, and that over time the franc was actually getting stronger. So it's very likely, we don't know why, maybe it's a financial crisis like 2008, maybe it's a pandemic, maybe it's something else, the exchange rate is going to change. Also very likely, the interest rate is going to change in a way that's uncorrelated with the Polish economy, because the Swiss central bank doesn't care about what's happening in Poland, it cares about what's happening in Switzerland. What does all of this mean? The Polish banks knew with reasonable certainty that at some point, the cost of paying those loans back in zloty would be much higher because the value of the Swiss franc would change. Doesn't matter if it's in, they didn't know if it's in 5 years or 10 years, they don't know exactly why, but they knew it's likely to happen at some point. And they knew that if their consumers can't pay the mortgage at some point, then they're going to default on that mortgage and lose their house. That means that the banks knew there is a massive risk to the consumers, which will happen at some point. True, they know exactly, they know exactly why it will happen, but they knew it will happen. And look, exactly the analysis that OG gives you about why they knew about the history works the other way. There was a crash in 2008, there was a crash in 2000. Banks know that at some point the economics are going to change, all of which means that they knew it is very likely that the consumers taking Swiss loans now would be happy for the next 5 years, maybe 10 years, but within the life of the mortgage, they're going to go bankrupt on it, and that's terrible for them. Second, let's talk about why the banks actively pressure them. We think it's important to know that banks have fiduciary duty to do what's best for the consumer, not to inform them, but to do what's best for them. That's A, because governments know that banks have much better access to information than consumers and could easily trick them and beat them. But second, because banks have access to government bailouts and to government subsidies and help, and the government will demand in return for that they act in the best interest of the consumers. That means that A, they not only have a duty to not actively pressure them, already knowing there is a risk and not helping the consumers is a crime in and of itself. But second, they actively pressure them because A, they could just make more money. They could push them into loans that were unofficial for them, that were bad for them, but made more money for the banks. But B, if this was the management decree, it's good for the employees to do what the management want, even if it means pushing consumers into investments and loans that are bad for them. All of which means that they are very much guilty. Let's understand the impacts of this. At the most basic level, we think it encourages the banks to push other consumers into risky products that are going to go and make them go bankrupt because they know they won't face any scrutiny and won't be punished for that. But on a second level, we just think that we cannot regret the law as it is written being obeyed and commenced. Finally, we think it also affects future ability of the law of other big companies and institutions. If they know they can get away with it because the EU wouldn't rule against them, it's much less likely that they will care for the consumer and consumer law. But finally, even if you accept none of that, we think it's much better in this specific case for the banks to bear the cost rather than for consumer to bear the cost. Look, the average consumer will lose their house. They have no capacity to have litigation on a private basis. They have no money or ability to actually litigate it by themselves. Further, they have very limited alternatives, right? They are going bankrupt and alone. Nobody will borrow them new money. They're probably older. They don't have money for a new down payment. They're going to lose their house and they're not going to be able to get anything in return, right? And they're a much more vulnerable group of people because the people who are likely to go bankrupt due to a change in the currency are the people who are already having difficulty paying back the loan, the people who are already on the margin. So it's important to make sure these people have remaining houses. On the comparative, A, the banks are very, very unlikely to suffer significant damages. I've already shown you in the rebuttal. B, the banks were much better informed and had much better knowledge of the risks they were taking that the consumer could ever had. So they were much better placed to decide whether they want to bear these potential possible costs or not. But finally, they're much better able to handle these costs. Before I continue, I would like to take second house, CG.
Your risk argument is uncomparative. Poland is notably not the safest currency and economy. How do you know they were dealing in bad faith?
Look, we're not saying that if the Polish economy collapses and the person loses his job, he can pay the mortgage on both sides of the house. However, the person is getting their wage in zloty and he's paying back the bank on loans in zloty. That means there is no risk of foreign exchange changing, which can change very rapidly, unlike the state of the Polish economy. Second, they are lying to you about the Polish economy. The Polish economy has been growing rapidly over the last 20 years because banks from Germany, because industries from Germany are using the cheaper Polish labor to move manufacturing and to move business to there, which means Mercedes, BMW, Audi, pharmaceutical companies, etc., are working there. The economy is consistently growing. They have low inflation of just 3%. They are not in an economic crisis. They grew by 1% this year and 3% last year and expected to grow next year as well. They are not going bankrupt. We don't think there is any reason to think the Polish economy is particularly dangerous, especially when interest rate risk and forex risk are the biggest risk when it comes to mortgage, because it means your ability to try and pay the mortgage changes drastically overnight compared to anything that's happening to the economy in general, which is likely to be A, gradual, B, not affecting you to the same degree, and C, the bank has much more control about loan it originates in zloty, and it can give prepayment plans to these consumers, which it can't with foreign banks. For all those reasons, we call you to oppose.
Great. I thank the speaker very much for a fine speech. I'd like to give the floor to the Deputy Prime Minister to continue reciting today's debate. Hear, hear.
Hi, can you hear me? Cool. Just give me 1 sec. Cool. Beginning in 3, 2, 1, go. If I'm a car salesperson, I shouldn't be liable for selling a car. That's most of the case that comes out of open opposition. In order to win this debate, I'm going to prove specifically why these banks don't have liability. The weighing on this specifically is that it is the specific reason why this decision came out in the first place and exists independent of those outcomes. In that, if we prove that these banks weren't liable for these decisions in the first instance, then any consequentialist impacts after that don't matter because the premise for that decision doesn't exist on side opening opposition. What do you need to establish liability? I think you need 3 broad things. I think firstly you need negligence, i.e., the knowing, like knowing that you've done something wrong in order for you to be liable for that. I think secondly, you need the lack of a meaningful alternative, in that even if this decision was bad on opposition, if you don't have an alternative that you were either A, offered at the beginning, or 2, that you can get out of this bad situation then that presumes liability. But I think thirdly, and most importantly, you need intention to have created this in that bad faith, i.e., if I intend to murder someone, I'm held liable for that. And this is the reason why, like, say, someone who intends to murder and someone who doesn't intend to murder, these are separate categories of crimes. If we can prove specifically that that intention doesn't exist, that liability doesn't exist in the first place. Sure, clarification. Also, pure than chat.
Manslaughter is still a crime.
What? Okay,
Manslaughter
yeah. I get that. I was just trying to talk about the distinction between these 2 things. Cool. First thing on like why specifically, like all of the stuff in opening opposition just falls out of the debate. They say mortgages are 25 to 30 years and economies change. Therefore, banks know that economies change and they will know that it changes badly, and therefore you establish liabilities. I think just because you have knowledge that economies will change is not an a priori reason to establish bad faith. I think there are a couple of things here. I think firstly, it's impossible to predict whether an economy will go up or down. But secondly, if consumers default, banks themselves lose money. In that, if these customers are now unable to pay back their loans, these banks themselves will lose money. Therefore, that nonsensical claim from opening opposition that they know that these economies will change for the worse, and therefore they'd rather lose their they'd get consumers to get their money back. I think the crucial thing they say next is that when they're bankrupt, I think the presumed assumption here is that you can do stuff like recoup their house, etc. There are a number of reasons why this also doesn't change banks' behavior. I think firstly, because many people who default on their loans, when they do give their assets to the bank, they still are in default. In that, if you've taken $1 million loan for a new house and you give that bank the new house, you still have a lot of the loan that is still left over. But I think secondly, it's just incredibly hard to recoup this investment. In that, you need to do stuff like repossession procedures, in that you have to go to the court and actually tell them and fight a case in the court to be like, this person isn't able to pay their loan. Now we want to take their house. You need to do stuff like assessing the value of those houses and all of that, right? I just don't think banks want consumers not to pay their loans in the end. And therefore, all of the stuff in opening opposition about how economies change for the worse and now consumers won't be able to pay is something that's good for the bank. I think that's just counterintuitive and illogical. The second thing they say is that you have an active duty towards consumers. I think one, this is the reason why banks probably operate in good faith, but even even more importantly, their next claim is that you have a safety net and therefore you can do risky decisions. Why is a safety net unlikely in the specific Polish context? I think firstly, because the central bank in and of itself has incredibly low money. All of Sharon's analysis, specifically on how this is predominantly an agro and manufacturing base, but also all of the stuff that opening opposition says in terms of how a lot of companies are using cheap labor from Poland. When the base of labor in and of itself is cheap, the ability for individuals to pay taxes is also quite low. Therefore, the amount of reserves that these banks, the central bank necessarily has, is incredibly low. I think secondly, there's a huge amount of corruption in Poland. They concede this, but there's all like literally look at all of the news about vote rigging, etc. There's a lot of proximity between the central bank and doing stuff like siphoning money out of the central bank. Therefore, the capacity for the central bank is incredibly unclear. But I think thirdly, like the amount of reserve money is low because of the lack of foreign investment. The lack of foreign investment simply exists because there's a lack of an integration with the Eurozone and the ability for businesses to operate in the same currency, i.e. the euros. That is to say that like foreign businesses specifically look for like ability to harmonize currency, like the ability to easily like exchange currency, where they're unable to do that because you have a different currency in the zloty. You just no longer have that safety net on side opening opposition. What that means specifically is two things. One, it's unclear why banks rely on the central bank in order for that safety net to accrue in the first place. But two, the safety net just doesn't exist on side opening opposition. Therefore, these risky decisions just don't happen. At the end of all of this, you ought to buy one. It's unclear why banks want to actively lose money, which is something that they need to defend on opening opposition as a premise for their liability. But two, they are unable to have these safety nets. So even if they do like knowingly tell these people that their risky decisions are bad, they'll be unable to recoup that investment. Therefore, that's also a net negative. But I think thirdly, even if one of these Polish banks does so, when the amount of reserve is quite low, you can't do so for several of these prominent Polish banks, especially at the point at which a lot of these banks just generally have a lot of money. Second claim then on why consumers have a meaningful alternative. I think what all of the rebuttal that I talked about, one establishes the fact that there's no negligence, but two establishes the fact that there wasn't bad intention. What this will prove specifically is why consumers weren't necessarily pressured into this and had a meaningful alternative. I think the simple premise here, Sharon tells you, is that you had options to take it in zloty and franc. There are a number of reasons for this. I think firstly, because of nationalist fiscal policy making, people like Donald Tusk, people like the fact that a lot of Poland historically has been economically conservative, means that you want to keep as much money as you can in zloty. I think secondly, there's just proximity between the bank and government when a lot of the policy decision making was centered towards these banks, necessarily have an incentive to do so. Before I move on to the third reason, I'll take opening.
Look, it's very clear that bankers have a short-term incentive to make the most money now for their bonus, for their employment, for their job. They don't care about taking massive risk for the consumers on the foreign exchange market in 15 years from now.
See, this is just stupid, right? Because they give $1 million loan with a term of 30 years. They don't want to make 50,000 of that in the first year and then not make money into the future. They want to recoup all of that million plus interest. That just doesn't work. Cool. What's the third reason why consumers have a meaningful alternative? I think this is literally because of reserve banking requirements that a lot of these banks have. You have to keep a proportion of money in reserve in zloty. The reason you want it in your own currency is a few things. One, this is the currency that you have most access to both at the bank, but also at the national level. Two, you do an incredibly large proportion of your spending in zloty. Therefore, you have an incentive to keep most of your money in zloty. And I think thirdly, you as the government collect all of your taxes in zloty. Therefore, like imposing this like reserve banking requirement on these banks is much more beneficial to you because these banks also do pay their taxes to the government in zloty. Consumers then have a meaningful alternative and were probably offered the ability to take it both in zloty as well as Swiss franc at the point at which they took it in the Swiss franc, or like at the point at which they took it in that Swiss franc, that is a decision that they made on their own accord. At the end of all of this, we've proven one, why banks aren't liable to the fact that they just don't want to lose money, but two, because consumers have had a meaningful alternative and therefore they have no intention. It's the most important thing in the debate. For all those reasons, was
Great, I thank the speaker very much for a fine speech. I'd like to give the floor to the Deputy Leader of Opposition to continue their side in today's debate. Here.
Can you hear me well? Okay. I'll start my speech in 3, 2, 1. I will deprioritize the principle because I think that it's basically the only positive thrust that OG have. I want you to notice why the framing from DPN that the principle is like really important and any like consequences depend on this is untrue. It's especially untrue when it comes to financial law and stuff like that. The reason for this is that we take into the account the consumer welfare when it comes to antitrust law. This is why we break apart mergers, even if we think that it harms the like ownership and things like that. This is why we don't we make creditors default even when it is the fault of people who take out loans because we think that it's better for the citizens. We think that for these reasons, you can prioritize that even if the principle is wrong. So let's talk about consequences. The first thing is just to take out the fucking absurd gov claim that the collapse of a few banks makes interest rates like across the country rise. The first thing I want to note here is that even if you accept all of the rebuttal out of DPM, you still have the EU that can give you money. All I need to show you right now is that they have the incentive. And saying that they're not part of the euro isn't establishing why they don't have an incentive. It's simply establishing why the euro isn't one. So why do they have an incentive to bail out Poland? Firstly, and most importantly, they don't want the current like Tusk government to seem like a financial hellhole. This is because they hate PIC, the fact that they rally and caucus with Hungary in many decisions, for example, in a pro-Russia sense, or in sorts of things like lower tariffs across the EU for countries like Germany and France. That's really bad. They want the Tusk coalition to succeed, which means that they care about that one vote much more than the small amounts of money that they need to do in order to bail out important Polish banks, which is why even if they have no commercial interest, the political interest of votes is enough. Secondly, they obviously have a commercial interest. This is because many parts of Eastern Europe that are more agricultural in nature and provide things internally in the EU in terms of transport lines are more important right now, especially given the war in Ukraine. So the Polish supply of such things is really important. Monsanto in Poland is the biggest in EU after France. We think that that's really important, and they want to make sure that these companies don't collapse and that have their banks to invest in. For these reasons, the EU will lend. Secondly, even if you are not convinced that all major banks will be saved, we don't need all of them because it's not that hard to move from one bank to the other, right? We think that you can just take your checkings account and notice that even if you can't take all of it, you can still transfer it to a bank, which makes their impact incredibly short term. Even if I lose money right now, insofar as I can make money and work in a few years, I won't feel that dent. Thirdly and lastly, we flip them because if it is true that the fundamental impact on individuals is so bad and that gets covered on the news, this is not true about all fucking banks in Poland, not just the few that we're talking about. People stop investing and putting their money into banks and notice that with Poland's incredibly high low inflation rate as of this year that has so far been positive, this can quickly spiral into a deflationary crisis at the point in which people start mistrusting banks enough to lower inflation into dangerous zones. Let's talk about why it is that even if you didn't buy any of that, we simply weigh on the impact of the individuals that won't get back like the things from the trial. Their literally only response to this is, but courts won't take my house, but the banks won't take my house because they don't know how to do law. Firstly, they have many teams that do this. This is how banks get most of their money, right? So they have entrenched lawyers. They have the lawyers with all of the money as compared to the people on the ground that are completely bankrupt, which is why they do have the incentive to do this. But secondly, notice that if it's not paying me, it's paying a Swiss bank. Someone here needs to get paid, and it's much easier to fight me in court than it is to fight a Swiss banking court that has many more lawyers and that's backed by a strong currency. We think that this is why I do force people with strong student debt with a lot of mortgage to pay me back. Why are they the most important population in the round? There are a few things that make them so. The first is that these tend to be older people. So if I take out a loan in order to start studying or in order to get a mortgage and settle down in a house, it probably means that I am a family, which means that my lack of money, whatever, will affect my less probably breadwinner of a spouse, and my children means that I can help them less. But secondly, these also tend to be the most vulnerable. And this is because we explained to you in LO that the people who are poor are the ones that need to take loans on the biggest things in their life. No one wants to live in with a mortgage. No one wants to have ongoing student debt that collects over time. The people that remain with that are those that cannot pay it in time, or those for whom if you take away their money, it's not the difference between whether they buy a house or rent. It's if they have to move back with their parents. It's if they have to cut down on essential utilities. It's if they don't send their kids to school. This is why this is the most important population in the round. And as I already said, when you're so scared that these are the sorts of people featured in the news, that this is the sort of collapses that bank financial mismanagement can lead you to, that's the point at which you move away from those things. I want to talk quickly about the principle. Because what I told you is really, really simple. I want to frame what banks are, because I think OG misunderstands that this is an active harm. What we need to prove in a trial is not that you inflicted harm, it is that you didn't contractually fulfill your obligation. And notice that this is the difference between bad faith and being like needing to prove that someone is a malevolent actor. You don't need to prove malevolence if you prove that you don't fulfill your end of the contract. The reason why you don't fulfill your end as a contract, as these banks in Poland, is because these started out as commercial banks and turned into investment banks over time, right? At the beginning, they were all about giving you the transparency and only being about gathering the data and allowing you to make the most informed decision. So even if they didn't reflect to you the fact that these trends that Will explains already happened, which made it so many people transferred into the franc, means that they already sin. So this is why the burden of proof for that is much lower. I will take second half before I continue.
Are these banks, which are facing this new financial burden, likely to get bailed out, and by whom?
Yes, the EU. Let's talk about why we think that more foreign currency, specifically Swiss, is really bad in the economy. The first reason for this is that Forex is bad. If I need to all the time take a commission on my currency, especially when there are many people doing this, and especially in Eastern Europe, there's a monopoly on these sorts of things. It's only Forex, it's not other companies. We think that means that you can take a 0.2 on the currency. This is bad because this is a 0.2 that would have gone into funding a local business that I will pay more for my groceries with. It's bad because it's money that would be taxed by the government and go into welfare. It's just a lot of loss. The second thing here is also that currencies are just misaligned. So in a time of crisis, which is probably the most important time for a central bank to have access and control over the Polish currency. So for example, if we start facing the deflationary crisis, which we alluded might happen, or if we start spiraling back into hyperinflation, which Poland has been known to do and has in the past, it's unlikely that a central bank can sync up and make sure that these things are prevented when they can't do things like quantitative easing, raise or lower interest rates, because they're not in control of a lot of the currency within their economy. Notice that this is a very important impact because it affects times of crisis. The central bank needs control most when people stop investing, and that's really bad, or when things get so hyperinflated that the value of my currency can no longer buy me these things. This is why it's super, super important that we have our own currency for all those reasons alone.
Great. I thank that speaker very much for a fine speech. I'd like to give the floor to the extension speaker from side closing government to open their side in today's debate. Here.
Hello. Please just raise your hand for a POI. Let's talk first about bank insolvency and spillover. First, the distinction here from OG. They tell you about the repayment, about money that the banks need to take out of their vaults and give to people. I'm going to tell you about the other half of the judgment. It's a two-parter, compensation and voided future payments. This is an argument about the voided future payments. Why is this likely to be the majority of the $25 billion? The Polish economy has been growing in the long term. This is told to us by OO. So more people probably bought homes and bought mortgages and bought bigger houses in the last 5 years than, say, in the 5 years 20 years ago. That means that the balance sheet of future money owed to the bank is kind of weighted further out into the future. OO says that these banks are going to be stabilized either by the Polish central bank or the EU, depending on which speaker you believe. This is unlikely to be true because, one, there are other banks, according to OO, in Poland, which are doing fine, not vulnerable to this. Why then would the central bank give money to the bad, expensive bank that's going to do less with it, rather than the good one that can actually use it to decrease interest rates even lower, prop up business, etc.? Second, this is expensive because these banks in particular are on the hook for euro payments, whereas the other ones are dealing in złoty payments, things that the Federal Reserve of Poland can deal with more cheaply and easier. Third, EU assistance, per the response to my POI 2 minutes ago, is incredibly unlikely because that's the body that just ruled against the companies. They probably made the same assumptions about bankers being evil that OO did. So they are the last people in the world that are going to turn around and essentially volunteer to pay the bank's fine for them. What then are these large prominent banks, of which there are many, going to do now that they are stuck with their balance sheet not looking how they expected? they have to raise interest rates on other things. They need to make up the revenue because they have probably been expanding on the assumption that they have this revenue. They've been lending out money to others on the assumption that they have this future revenue, etc. This is bad, even if there are other banks to turn to, as OO said. First, I'm not sure it's as true, right? These are the major banks. It seems like this is like pretty normal. But even if everyone does turn elsewhere where there are cheap interest rates, this just pushes the interest rates for the remaining customers up higher because this further diminishes the revenues of the banks that are on the hook for this judgment. This means that the creditors of this bank don't get their money. The bondholders, the companies with accounts there. OO says you can just pick up and move your checking account. But if everybody picks up their money, there's going to be $25 billion missing that they thought would be there. That's just not going to work. I think these are especially likely to be major companies, these sorts of companies that are fueling the growth in Poland, because these are the prominent banks. They likely work with the largest institutions, and they're likely to be a fan of this Swiss franc system from when it existed, because this is like pretty advanced. This is more than just your average credit union. This is doing international banking. This is probably the not only the most prominent, but the most advanced, the highest level of offering for the banks. This argument then works on two levels. If any particular bank gets like completely screwed, i.e. there's a run on it, it goes bankrupt, whatever, then that's just really bad and expensive because not every creditor will get paid. This is just as bad as the people, or worse than the people who are like on the hook for their mortgages, because there's contagion risk to other banks. Each bank is interlinked, they share reserves, lending to a wider number of companies, etc. This means you have trickle-down impacts when like companies get screwed, people get laid off, etc. So you end up having far more people fall behind on their mortgage, lose their home, etc. Even if no bank gets like a complete run on it, they're still profit maximizing and needing to restabilize, so everybody will have to pay higher prices. Second extension. Advising clients to take out loans in zloty, the counterfactual that OO says these banks should have done for the last 50 years because they should have predicted foreign exchange rates, is actually worse than encouraging them to turn out in francs. We cannot just like figure out what happened and then use that to know what was the right decision for the information at the time. What the EU ruling encourages is a different form of negligence, of super risk aversion. The banks are likely to overcorrect and offer the most tame advice possible to their clients at the expense of prioritizing the best interest. These look like investment decisions, loan and mortgage decisions, etc. These are going to get shorter and more expensive. They're going to get more domestic because they're just told that when you take a risk, even if you think it is for the best for your client, you will get punished for it. This is a cultural shift in the banking industry of Poland, where the rule is now not to do what you think is best for your customer, but rather do what you think protects the bank from the risk of international litigation against you and losing a $25 billion hole. This is particularly likely to be with international regulation because it was an EU court, not a Polish court, that handed down this decision. That means that Poland and the banking sector and investment sector is particularly likely to pull out of this because they are fearful of other things. Note this is conceded when they tell you about the deterrent. This is bad because per OO's own argument, it is international involvement, the ECB and like German auto companies who are fueling Poland's growth. The more you discourage them from coming, or the more you are averse to investing in them, or the more your own banking system fails them, the more you are going to lose these driving factors of growth. Opening.
Insofar as your analysis is correct, and there is actual contagion risk from those banks to people we care about, it's more incentive for the EU and Polish central banks to bail them out. You can't have both. Either it's not that risky, or they're going to be bailed out.
I can have both. The EU, who just sanctioned them, it is not tenable for them to to bail out the people they just fined, because that makes the justice system toothless. Second, I'm unclear why the motivation is super high at the point where they say, look, this is a Polish problem, you need a Polish solution. So if there is a bailout, it is more likely to happen domestically, which just means like taxes raised on everybody, inflation, all of the reasons bailouts are bad. And this would mean that none of the accountability that OO wants to talk about happens, because they also can't have it both ways, right? If it is the case that it's a bad enough problem to bail out, and it does get bailed out, then there's no accountability, nobody actually gets helped. The costs always get passed on to the consumer instead of the so-called negligent bankers who are acting in bad faith. They don't get any of their impacts in that case. I think what you are left then with from CG is a explanation of where the majority of the issue happens, not in the repayment, but in the lack of solvency for the bank, the potential for a run on it, which will have major problems for all the international companies, and then the fear of future regulations and cases like this stopping growth. Propose.
Great. I thank the speaker very much for that fine speech. I'd like to give the floor to the extension speaker from side closing opposition to open their side in today's debate. Here.
Can I be heard?
Yep.
All right, perfect. Yeah, I'll take POIs. Yeah, I'll take POIs in chat. I'll accept one around 5 minutes. Just have it ready. So if the bank is big enough to justify a financial bailout, they'll be bailed out. In the instance where it's not big enough, you're not going to bail them out. I don't know why bailing out is such an important thing. I don't really care whether or not you bail out the banks. I think if it's such a big bank that's so financially important, it's likely they're going to get bailed out because you don't want the country to go into a recession. If it's not, then you're not going to bail them out. Big deal. I don't really give a crap. What I want to point out is the second extension we get from CG. And CG says you're going to overcorrect. And I want to point out why this is unlikely. The reason you're unlikely to overcorrect is because you still want to make some money, which means you're likely to give the consumers the best choice insofar as they're likely to come back to you if you give them the best choice. But secondly, I just want to point out the reason you actually find them in the first place is not because they gave them advice. It's because they gave them asymmetric advice without properly disclosing all the information. It's because of that correcting mechanism that OO talks about that you're actually able to ensure that they are corrected. You're ensuring that they actually give people the better information in the future as opposed to a lack of information right now, which means you're still likely to support them for advising. The reason you weigh this litigation against them is because of the way in which they did so, i.e. it was very insofar as it was untransparent, etc. So I want to talk about the principal liability because I think top half is at a bit of a deadlock. So opening opposition makes the weird argument that banks knew that they were going to crash and force consumers into this very bad action, and banks knew that the Swiss franc was going to go down. OG rightfully points out that's unlikely insofar as it's probably true that banks don't want the Swiss franc to also go down insofar as they also probably have investments banked on it. So I think that's a bit of a wash on top half. So why do I think the banks are principally liable? I want to point out that there's negligence. Insofar as even if they did know, even if they did not know, I don't really give a crap. I think they had an obligation to know insofar as they had the resources to properly map this out. I think the banks failed to conduct proper due diligence. They failed to do things like assess potential risk. They failed to do things like didn't understand the volatility in currency exchange, etc. So even if they knew or even if they didn't know, the fact that they should have known means that you weigh on that. This is why you weigh things such as, for instance, intention very rarely matters in court trials. What actually matters is the outcome, because intention doesn't really matter insofar as the outcome is bad, because you should have known, and I think you can weigh that against them and levy that to them. But secondly, the real reason you actually charge them, if anyone was willing to read the news article, is because they had unfair terms within their agreements, right? So they often constrain unfair terms, which put borrowers at a disadvantage. Insofar as the contractual provisions were unaware, people weren't adequately disclosed as to the risk associated with that. So I'll acknowledge that traders probably cannot predict the unforeseeable foreseen events. I'm not going to take the burden that OO does. But I think that what the code does is that it stated information to individuals, i.e. the banks gave them information without properly giving them the other side of the information, i.e. the flip on this information. Is it likely that it's going to crash or not? I think you ought to give people that opportunity, and they didn't. But secondly, the contracts were also not written in plain language requirement, which means that you ought to draft contracts in a bit more of a plain way that the average person can understand. Insofar as you create the coercive environments for why they do so, we think you ought to do them legally. But I also don't think this is a meaningful clash in top half. Insofar as legal accountability was already determined by the ECG, the reason you actually tried them and the reason that you charge them is because they ought to have done something better, and they ought to have considered the outcomes for the person. They obviously considered this on a case-by-case basis. They obviously considered whether or not average individuals were coerced into this choice. I want to make a much better argument. I want to talk to you about why I think we better benefit the Polish economy on our side of the house. Number one, consumer confidence. Note that by holding banks accountable and by ensuring that the treatment for borrowers is guaranteed, you also boost consumer confidence because consumers feel protected and they feel empowered, which means they're more likely to participate in economic activities. They're more likely to invest. They're more likely to spend money. They're more likely to borrow, etc. But second, I want to point out the stability for the housing market in Poland. Note that borrowers who were previously uncertain about the mortgage contracts can now actually own their houses, which means on the comparative on their sides, banks own these houses. So why is this harmful? You have a surplus of houses that are owned by banks. When banks have too much houses, what do? They put them out on the market. When you sell too many houses on the market, when you have too much supply and too little demand, what happens? The price goes down. Note that 20% of the GDP in Poland is literally the housing market. Insofar as that is true, we think when banks have a surplus of houses and list all of these houses on the comparative on their side of the house, you have a crisis which leads to recession. Does anyone remember what happened that led to the 2008 financial crisis? Oh yeah, the housing sector, which means when the housing sector is so pivotal to an economy and so pivotal to the GDP, when you have too much of these houses being sold at one point because people no longer own the houses and banks do and have an incentive to want to sell them off so that they can pay back the liability that OG kind of brags about, I think you're likely to have the crisis, which is a bigger burden impact, i.e. you hurt the economy of a country that's already struggling because of recession. But secondly, note that on the comparative, you have legal uncertainty because on the courts, if the court doesn't make this decision, then banks have to engage in this on a one-by-one basis, which means you have uncertainty insofar as you have to engage in lengthy litigation to seek things like compensation and void claims. So not only are people structurally locked up, they continuously have to go through that cycle where they feel as though they might get something, but in reality they won't because of the legal teams that the banks have in order to levy power and levy coercive power. But secondly, I want to point out that the banking sector has better resilience mechanisms on our side of the house because it encourages them to reassess their practices. This doesn't lead to overcorrection, as CG unfortunately points out. What it does is it actually leads to them correcting righteously. Insofar as they still want to make profit, they're likely to want to try and make profit and therefore engage in these practices. But second, it just allows them to disclose things to the average individual. So maybe it is true that the banks didn't know, but I think they should have told the people that this is something that could have happened. Insofar as Switzerland had low interest rates and there were economic reasons for why they were likely to have higher interest rates in the future, I think the banks should have taken that obligation. They should have actually looked into it. And I think they ought to do that. But fifth, I want to talk about economic recovery here, because obviously since borrowers are going to receive compensation from banks to some degree, i.e. on missed payments that they paid in the past, they're able to regain financial stability. This fits the argument that OG points out, because OG says this leads to like worse relations between Poland and the EU. But they fail to consider the vast majority of people who take these loans out are actually right-wing people who are somewhat on the ground, i.e. the working middle class, which means when you prioritize the working middle class from an EU point of view, they're more likely to support you in the later regions, i.e. they're more likely to view the EU as being favorable in terms of their best interest because they feel as though they've done so in the past. I'm sorry I didn't take a POI near, Claudia might take two later on. I'm going to run an analytical secondly on the argument that they push on OG, i.e. on whether or not this ruling is bad for commercial banks and why I think it leads to good outcomes for these banks. So the reason for why I think this is important is the first thing that it does is it obviously doesn't mean that you're going to charge all banks the fine immediately, right? Like banks are like, it's obviously unlikely that the court is stupid enough to charge them immediately, which means that it's probably going to be the case that the fine is spread out over a period of time such that the banks don't have to collapse. But I want to make the assertion that they already own these houses at this point in time, which means they probably gave the houses to the people while owning them. So I genuinely don't know why the banks are going to collapse. The 25 billion isn't the direct fine. Only 50% of that was actually a fine. The rest of it was a consequence of you not being able to charge mortgage payments on that. The weighing here is simple. We first benefit the economy, which is a prerequisite to all the analysis that OO gives, insofar as the people are dependent on the economy being successful in order for them to be happy. Insofar as you don't let a recession happen or you don't let an economic crisis happen where you have too much demand insofar as too many houses go and you have a problem with the individual actors acting in their own individual way, i.e. the collective action problem from banks. I think we're able to better benefit the economy. I think that's a bigger impact that you can weigh on. So proud to win for closing position.
Great. I thank the speaker very much for a fine speech. Let me pause the recording. Resume the recording. Okay, thank you everybody. This was a very interesting debate. We had a very productive and fun discussion where we started with different calls and ultimately came to a unanimous decision. The call is first goes to opening opposition, second goes to closing government, third goes to opening government, and fourth, unfortunately, goes to closing opposition. So first to OO, second to CG, third to OG, fourth to CO. Why did we reach this call? So from opening government, we generally get three broad things, claims. The first is that there's a liability claim, that they are not liable, the Polish banks in this moment. Secondly, that this may lead to economic harms. And thirdly, that this may lead to a rise of Euroscepticism. Ultimately, on the third point, there is a lack of analysis for us to credit it, but it was also fairly well responded to from opening opposition and wasn't really brought back from the Deputy Prime Minister, so we didn't really credit it. On the first point, in terms of liability, I think you give a decent amount of explanation as to why this could be plausible. And even if I were to completely accept this point. What I don't understand is why is this something that I should care about within the debate? And there is a justification about this somewhere out there that could be given, but absent of a given explanation as to why we should care about culpability as a first metric, other than other competing metrics that exist in the debate, by your own arguments that you provide in terms of practical outcomes, but also arguments by other teams, I don't necessarily understand why this is an issue that I should care about. And this, in terms of the top half clash, is a wing that is directly given in the deputy leader of opposition towards this clash by simply explaining we should care about practical reasons more than a nebulous principle. Here are multiple analogies that this happens in terms of antitrust laws was, I think, one of them, in terms of breaking up companies, etc., etc., which ultimately brings down to that the decision of the top half hinges on the practical clash. Now, the claim that you forward in this debate is that when this liability is put on the banks, their currency reserves will drop, which means that they have to necessarily increase their interest rates in order to offset the harms that happen to them. The implication being that this is bad in terms of loaning and your capacity to earn loans and these type of things. The first problem with this case, without even explaining what is the comparison with opening opposition, is there is a lack of explanation as to what is the alternative, i.e., if this were to not happen, let's say, in an alternative world where the Polish government is, the Polish banks are not viewed as liable, who will then recoup the debt? And I think that this is a significant burden that needs to be explained in order to make sure that your claim is comparative, i.e. why it changes. Otherwise, it's just a claim as to why something is bad, but not necessarily why it will be fixed on the other side of the house, which is ultimately where opening opposition picks a lot of holes with you, where they explain that actually on the comparative, the end consumer is the one who will take the brunt of the cost, and that the end consumer cannot take on these particular harms, for example, losing their house and stuff like that, whereas the bank at least has one, some capacity to take on these particular harms, and two, that there are other actors, both the Polish national government and the European Union, to maybe to bail out, but maybe not bail out, but in general fund these types of banks to make sure that your harms are offsetted. Meaning that opening opposition is able to mitigate to a certain extent the harms that you propose in this debate and explain that on the flip side, these harms are much, much worse and harm a more, how should I call this, a more vulnerable group, being the end consumers rather than the banks. Which means that very cleanly opening opposition beats opening government in this debate. Let's bring closing government into the mix. I would posit closing government runs more or less the same argument as opening government, which goes along the same lines. If there isn't, if like the banks bear the cost of this harm, then most likely they'll be forced to do some kind of negative action. So where do we think that closing government, and I want to be very clear, extremely slightly is able to extend on opening government? The first thing is there's a lot of rebuttal towards the alternative posited by opening opposition, where they explain that, look, the EU is unlikely to give you bailouts for this since they were actually the ones who imposed this type of sanction on you. There isn't that much political will to give things to, for example, bailouts, which means that the most likely alternative is national banks bailing out, the central bank bailing out these types of banks, which means that you are necessarily taking a portion of the budget. In order to offset this budget, you need to raise taxes, which ultimately harms people. So this is a first addition that has a destructive role against a pushback that already comes to opening opposition, that we explain to directly undercuts the case coming from opening government. But secondly, it also gives an independent harm with that. The second contribution that comes from closing government is an explanation that given that Poland has an expanding economy towards the past few years, most likely these loans have been given towards the past few years, which creates an assumption that the amount of money that will be given out, that the amount of money that is given out is exactly thinking along the lines of that a lot of money will be brought back in terms of the stability of these loans. This means that the projected revenue that these banks are supposed to receive is actually a lot, which means that if they don't have a capacity to receive this money, or they have another stopgap being pushed upon them, which is this 25 billion, the harm is likely to be greater because they were assuming that they're operating under normal and good economic conditions, when in reality they were not. this expands the impacts coming from opening government because it explains that the trade-off that this bank will have to make and the connectivity of the economy within the banks themselves is so great that the harms will be basically expanded. And finally, I think that there is a much more clear explanation in terms of contingent and how the credit score of the country will be depleted once this type of action happens, which lowers the investor trust. I agree, opening government have words on this argument. I just think that it's much more clearly explained in closing government, and these additional analysis that closing government provides allow them to extend more clearly on this point for us to understand, okay, after you've done this legwork, this is how economic contagion happens, this is how the economy overall goes down. So this is how closing government is able to very narrowly extend on opening government and why they beat them. Again, extremely narrow comparison. Maybe another panel would have had opening government being above closing government, but this is ultimately what the panel came to a unanimous decision on. Why does closing government lose to opening opposition? Basically, on the same reason, closing government do not explain what alternatively would have happened on their side of the house. Given that's the case, and given opening opposition until this moment does say, well, the average Joe or the average John, in this case, from Poland will have to bear the cost of this particular thing, which means that there is a much more direct implication of the impact, because and there are multiple ways from opening opposition towards this point, and for the similar reason, opening opposition beats the same reason that opening opposition beats opening government, they're beating very clearly closing government as well. Bringing in closing opposition to the mix, and here I want to be very clear. There are a lot of statements brought up by closing opposition. The problem is that many of them are either present in opening opposition or straight up repetitions on opening opposition. So, for example, when member of opposition explains that, for example, you have when they're talking about the moral point, you have an obligation to your consumer base, and you've ended up screwing them over, that's in opening opposition. Where you have asymmetry of information, and thus you have a liability towards them, that's in opening opposition. About the arguments about Polish confidence in the economy and how they can participate more in the alternative, that's again in opening opposition. The only thing that's not in opening opposition is this argument about housing, which you explain one part of the burden, which is, okay, why would the price drop? We buy this. We agree that the price will drop. The explanation being that if there is a huge, if the banks all of a sudden have a lot of properties, they want to sell it off in order to recoup their costs. So they will necessarily sell them at a lower price, which generally leads to a lowering of the of the real estate sector and this type of things. The problem is that then the impact that you provide is economic crisis. And the problem is that there is a burden between these two things, which is what happens in the middle to lead to this. The only thing that you come close to as an explanation to this is by saying that 20% of the GDP of Poland is real estate, which firstly is asserted. Secondly, kind of sounds like an absurd claim, if I have to be honest, like just stating this number out there in this particular case. So if you have such a big logical hole within the only argument that you are effectively extending on opening opposition, and this logical hole is too big for us in order to credit the implications of your case down the line, then it's very hard for us to place you above opening opposition, but also to place you against other teams within debate, which have less of a so high burden case and a much more analysis towards each particular burdens in them. So if you have a logical hole that's this big, we have a question mark when we're judging this argument. And ultimately, when we weigh it against more proven arguments, we're much more likely to credit them versus others. This is the justification. Hope it satisfies you. You can stay for personal feedback, or if you have to go, you can reach out to me on Facebook. And yeah, thank you.